Hey, Dan Passarelli here. How are you feeling today? I hope you're feeling great. I'm feeling great. Today, we're going to talk about a trading plan for all option strategies. Oh my goodness, is that even possible? Is that even possible? I mean, all option strategies are different. How can there be one trading plan for all option strategies? We can, and I'm going to talk about it. But before I do, I want to make sure you can hear me. Please head on over to the Q&A box and let me know if you can hear me by typing the letter 3. No, 3 is not a letter. Typing the number 3 in the questions box. Thank you, Justin. Thank you, thank you, thank you. Thank you, Jay. Thank you, thank you, thank you. Anyone else be able to hear me right now? Anybody else able to hear me right now? I hope there's somebody else able to hear me right now. Richard is able to hear me. How are you, my friend? Dylan? Okay, Gregory. We got the whole gang here. That's awesome. I love that. Well, before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading and get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. Now, I just saw a lot of the usual gang here, Justin, Gregory, and a whole bunch of other you. But, we have an open door policy. We like making new friends around here. So, for those of you who are not familiar with me, my name is Dan Passarelli, and I am an author of three best-selling options trading books, from Trading Option Greeks to The Market Taker's Edge to my most recent one, Build Consistent Wealth with Options. And I author a lot of other stuff, my Substack, podcast. Do you author a podcast? I don't know. I don't think it's really authoring, but I do a podcast once a week that is becoming more and more popular. So thank you for subscribing. In fact, in a minute, I'll tell you how you can subscribe. But who am I to write books and do podcasts and have a Substack following? Who am I? Well, I'm somebody who's been there and done that and is still doing it. I've been I've traded as a professional in few capacities for a long, long time, and I still trade every day in my trading accounts. I'm the founder of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries. I stopped counting after we got to 50 countries. So it's over 50 countries. Who knows how many it is by now? And let's see, students in over 50 countries, thousands and thousands and thousands of students we've trained. And we train traders just like you to reach your full potential as a trader. And I collaborate with a lot of other people in the industry. I was just speaking with a trading firm on the other side of the world earlier today. I just had a interview from a global podcast with like two 250,000 followers on YouTube. Geez Louise. And I do webinars for good organizations here like Firstrade, who obviously cares about you and your success because look, they're providing you with free education. It's kind of a nice thing to do. Outside of trading, I have other things in my life. I am a family man. Excuse me a second. Um, I'm actually on location visiting my mother, who's in Nevada, here with my wife and my son. My daughter's traveling. She's in Japan. The whole dog's still at home. And I also do other things. I'm a runner, foodie, traveler, musician, uh, gardener. I like gardening. So that's me. If you are interested in the podcast, if you listen to podcasts, and chances are you've listened to a podcast. I saw a study over 50% of Americans listened to a podcast last year. It's super easy to do. I'm going to show you how in just a second. But my podcast is called Wealth Building with Options, and it's specific to the wheel strategy. You will master covered calls and cash secured puts. If you start from episode one and listen, you will master covered calls and cash secured puts. It is great for wheel investors of all experience levels. Even some of the earlier episodes that start out a little bit more basic, I sprinkle the infield a little bit with stuff for even more advanced people. We cover adjustments, mindset. We've got some great interviews with psychology, trader psychology people, cover strike selection, analysis, everything. Every single thing you need. It's both strategy and tactics. And there's new episodes weekly. And you know what day of the week the episodes come out? They come out on Tuesday, and today is Tuesday. So if you start today, you can actually catch today's episode and work backwards. Or you can work from episode number. That's what I like to do. When I listen to podcasts, I start on episode one and I just binge the living heck out of them. I'm tenacious like that. Do you have a thirst for knowledge? I have a thirst for knowledge. So when I start a podcast, I just start at the beginning and binge it. Listen to it when I'm running, riding my bike, driving. It's multitasking, baby. The best part of this is that the podcast is free. Yeah, that's right. The podcast is free. How do you do it? I've made it super easy for you. Go to markettaker.com/applepod or markettaker.com/Spotify pod. And there's a little link there. You just click it and poof, it's like magic. You're on the podcast. Even if you've never logged into one before, poof, you're on it. All right. So let's talk about a trading plan. Those of you who are long-term listeners, viewers, I talk about trading plans a lot. Why do I talk about trading plans? Because if you don't trade with a plan, it ain't going to work. Because you know what? Look, you seek out online education on options, right? I can tell. How can I tell? Because this is online education, and well, here you are. A lot of that online education that you're likely to come across is setups for a specific type of trade. Hey, here's the setup for this credit spread. Here's the setup for this time spread. It's always about the setup. What criteria you use to get into a trade, right? Isn't that what you see online? That's what you see online. You don't have to answer. I know this. But you know what? That is not even half the battle. There's two parts of every trade. There's getting into the trade and there's getting out of a trade. And getting into the trade establishes your likelihood of success, your potential profit or potential loss with certain strategies. But where you get out of the trade determines whether you make or lose money. The getting out of the trade is much more important than the getting into the trade. In fact, that's really like the way I learned how to trade is on the trading floor, taking positions that I didn't even want, because somebody would just buy my offer and now, oh, look, now I'm short them or sell my bid and oh, look, now I'm long them. What do I do with this? So I had to figure out how to make money on positions that I didn't really even choose to take. That will make you a good trader. So if we need to be pretty good at getting into a trade, but we need to be great at getting out of a trade, well, there's a lot that happens in between that we need to prepare for. The only way this works is to use methodology. I use a trading plan to ensure that methodology is being followed because processes ensure successes. There's a guy, Edwards Deming. It's not a typo. His name is Edwards. I don't know. Uh, and he was an American engineer, statistician, professor, author, lecturer, and management consultant, famous in some circles. And this guy has some pretty good quotes. Let's take a look. If you can't describe what you're doing as a process, you don't know what you're doing. It's true, right? If you can't describe what you're doing as a process, you don't know what you're doing. Too many traders wing it. It's not enough to do your best. You must know what to do and then do your best. That ring true a little bit? Like, hey, I'm trading over here. I'm trying my best. Well, what are you trying to do? I don't know. I'm trying to, trade. I'm trying to make money. Okay. How? Uh, 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 uh. It's not necessary to change. Survival is not mandatory, right? Now that says something, doesn't it? You're here for a reason. What is your most valuable asset? Is it your house? Is it your car? Is it your dog? It's your time. And you are investing your time today. You lose money on a trade, you just make another trade and make it back. You lose an hour of your time, you ain't never getting it back. You're doing something very, very important right now. You're here to make a change. And so let's do it. I like to say this is before using a process. You ever felt like this? How about this little guy? Oh, yeah, this is after using a process, right? All right. So here's what I'm going to show you. A long time ago, so I was a trader on the floor of the Chicago Board Option Exchange for a number of years. Hold on, excuse me one second. I was a trader on the floor of the Chicago Board Options Exchange for a long time. And then, long story short, the exchange asked me if I wanted to come and teach classes for them. And long story short, I reluctantly agreed. Uh, and it was pretty life-changing for me. I took that step. It was a hard step to take, but you know, change is not mandatory, survive or necessary. Survival is not mandatory, right? I made a change and it changed the whole trajectory of my life. But anyway, in one of my first days of training people, someone said, "Hey, I trade a lot of iron condors. What is your the steps that you take to trade iron condors?" And at the time, I said, I just trade them. I didn't really think about the trading plan. Now, truth be told, I had certain criteria and I wasn't trying to hold back or anything. It was just that I didn't really think about the criteria. I didn't really think about, oh, yeah, I do this and then I do this and then I do this and then I do this. It's because I did those steps so many times that it just felt like one step, trade it. But in another session of teaching people, I had somebody else ask me, Dan, what is the steps that you take to trade a covered call? Dan, what are the steps you take to trade a credit spread? What is your process? What is your methodology? And I thought, okay, you know what? I've been asked this question a lot of times. That means this is something that people really need to know, and I should have an answer. So I started thinking about it. And here's the thing that I found to be difficult about answering that question. If I trade a covered call, I do certain steps. If I trade a straddle, I do a completely different set of steps, seemingly. So, what was I to do? Create a step-by-step process for every strategy known to man? Geez, that'd take me a couple of years probably to really do it right. So I thought, how can I best serve the most people easiest? And so I put in a fair amount of thought into sort of a first principles checklist, if you will. And this is what I came up with. This is called the MTM Trading Plan Checklist. And these are my steps. I'll look at the technical setup, identify volatility events. I do my volatility analysis. That leads me to stating my forecast. From my forecast, I select the optimal strategy. I do my Greeks and risk analysis, which is kind of partly tied into selecting the optimal strategy. I come up with a plan for my exit and my adjustments. Then I execute the strategy. Oh, wait a minute. Did Dan get the steps backwards here? Don't you come up with your plan after you execute the strategy? No. You're going to exit this trade at some point. All options expire. So you have to plan for that. You don't just buy, like there are a small handful of people who, like back in 1980 something or other, bought some shares of Apple and just like didn't touch them. Those people are now very wealthy. Doesn't work that way with options because they expire. You can't buy them and hold them for 40 years. Doesn't work. So knowing that at some point you've got to close the position or they're going to expire, get it exercised or assigned, you need to plan for that. It's part of the life cycle of a trade. I liken it to, like options are a trading or investing vehicle, right? Well, that word vehicle is common when talking about any financial asset, but it's not just like some sort of coincidental term. It's very pensively thought out because it is a vehicle. It gets you from one point to another, just like a car. And you don't get into a car and say, all right, what do I need for the car? Okay, I need the gas. I need to make sure, it starts, it's running. Need to make sure I've done my maintenance. Okay, I got everything set up, ready to go. I'm going to get in the car and drive. Let's go. Where are you going? Oh, geez, I don't know. I haven't thought about that. you would be thought of as a crazy person if you ever did that. But you know what? You don't do that because you know that getting into the car is just the first step to getting out of the car at a different destination, hopefully a better destination. Works the same way with options. Okay, so then after that, we have our our execution strategy, our trade execution, and then adjust and exit. There's actually a few more steps here. Hold on a second. How many is this? One, two, three, four, five, six, seven, eight, nine, 10. Here's what I'm going to do. No, I'm not going to do this right now. I have this set up this way for a reason, but you know what? There's two more steps here. One on the top and one on the bottom. Just like this is a delicious trading plan Dagwood sandwich. We need to put the buns on there. The bun that goes up top here is observe the market. I mean, we don't start setting up a trade until we get our bearings and see what's going on in the world. The bottom bun here is a post-mortem. What did we learn from this trade? Is anyone here the best trader that you could ever possibly be? Show of hands. Hit that Q&A box. Give me a yes if you're the best trader that you could possibly ever be. Go ahead, hit that Q&A box. Are you the best trader that you could possibly ever be? Nobody? Good, because I was going to ask you to leave. You are in the wrong place. And it's not because you're too good for this, it's because you've got a terrible attitude. Trading is always about learning. Look, the world keeps changing, and so the stocks that we invest in keep changing. We learn more. I've been investing or trading for over 35 years. I actually started in college, believe it or not. And look at all this gray hair. Look at it. Look at it. I still have my hair. I'm very lucky in that regard. But this is what comes from 30 years in the trading career. No, it'd probably be gray if I wasn't in the trading career, but I've been doing this a long, long time. And guess what? I am still learning. Oh my goodness. I shouldn't be attending a class by someone who's still learning. I should be attending by someone who knows everything. You show me somebody who knows everything, and I'll show you somebody who's a failure. It's very, very important to strive to continue getting better always, and that should be part of your process. It's the bottom slice of bread on your Dagwood sandwich here. All right. So let me ask you a question. Well, let me provide a little background and then ask you a question. So you would use this trading plan. I'm looking over here because it's on my other screen. You would use this trading plan for a covered call, cash geared put, credit spread, debit spread, calendar, diagonal, condor, iron condor, butterfly, iron butterfly, broken wing butterfly, straddle, strangle, short strangle, anything, just anything. I don't need to list all the strategies. You get it. Because this is versatile, it's general, and it's general intentionally, not just so that it could be used for any strategy, but as a reminder that these are the steps that you must take. And you have to think, okay, if I'm trading this type of thing, what do I put in volatility analysis? How do I need to manage my volatility analysis? This is designed to get you thinking. Every one of these steps is a source of edge. Every one of these steps is a source of edge. What if I could get just a little bit better at my technical setups, technical analysis? Does anyone think, show of hands, hit the Q&A box and give me a yes if you have completely mastered technical analysis and could not possibly get any better? Hit that Q&A box and give me a yes. Okay, I know nobody's going to do it. If you do, especially after everything we talked about, it'd be a little foolish, wouldn't it? We know we can always get better, even if we're very, very good at it. But what if you could just get this one more little discovery and maybe potentially add another 5% profit on average to your trades? Maybe on your winners, you make on average just 5% more. On your losers, on average, you lose just 5% less, right? That could add up, right? I mean, 5% is not a lot though, is it? Okay, but what if on your volatility setup, which I guess it kind of goes beyond identifying volatility events, it's kind of your fundamental analysis. What if you could get just a little bit better, right? Like, what if right now you don't go and always check to see when earnings are? Or if you're an options trader and you don't do that, oh my goodness, you're making a terrible mistake. Just a reminder to do that could potentially add maybe more than 5% fewer losses. How about start there? Okay, what about with your volatility analysis? You get just a little better and using those to come up with a holistic forecast that is very, very clear and standardized that you do every time. And learning to use that forecast to select the optimal option strategy. Hey, I'm bullish, so I'm going to buy a call. Okay, great. But implied volatility is massively high and you're overpaying for that call. And when implied volatility crashes because the stock goes up, you're going to make way less on the trade than you thought you were just looking at the delta because you're going to make on the delta but lose on the vega. If you could get a little better at selecting the optimal strategy based on your holistic forecast, which is based on your three analyses, technical, fundamental, and volatility, I believe you could easily add much more than 5% profit to your winner or lose much less than 5% on your losers. Greeks and risk analysis, working those in to become better, right? You know, many of you have commented in the past that you've read my book, Trading Option Greeks. Good, that's a great start. But you know, the more you learn, the more you earn, and the more experience you get with those Greeks, the better you deeply understand them and can more deeply apply them. Exits and adjustments, your execution strategy, actually executing the trade, um, your adjustments and exits. That could potentially add, I believe, much more than 5%. Pick one of them to get better at. You're already making more money. Pick three of them to get better at, and it's life-changing. This is important stuff. Now, how do we do it? Well, I'm going to go pretty general on this. You know, some of our webinars here with Firstrade are very, very specific and very, very detailed. This is very conceptual, but in some ways more important, in some ways more helpful to you. Well, so let's take a look. We want to identify the trend, right? We're looking for a breakout, a momentum trade, a channel. Is it a choppy market? There's no trend present. This is the whole point of technical analysis. What is technical analysis? What is it? You could define that in a lot of ways, but let me frame it this way. Technical analysis is a map of human behavior. Technical analysis is a map of human behavior. You ever think about that? What does that mean? Wait a minute, Dan. It's a map of human behavior? No, no, it's lines on a chart. All the candles and stuff, they're lines that give us the secret answer and predict the future, right? No, no, it's not at all what technical analysis is. Why does a stock go up? Hmm? Why does a stock go up? There's only one reason, believe it or not. Well, Dan, what do you mean there's only one reason? Sometimes they have good earnings, sometimes it's a breakout, sometimes it's blah, 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 blah. No, there's only one answer. There's more buyers than sellers at each particular price level. If you ever look at the bids and offers for let's say a stock right now, it'll show you the size offered. Hey, this stock is offered at $103.71. There are 300 shares offered. What happens if you put in an order to buy 500 shares at the market? Well, you buy 300 at, what did I say, 102.73 or something? And now the market is 102.73 bid for the remaining 200, and the offer is higher. You just made the market go up. If that was a market order, then you would buy the next highest level bid. And if you bought all that was offered there, then the offer goes up. And then somebody fills in a bid, and now it's higher. That's how markets change prices. They change prices because humans act and buy up offers so that the offers are no longer there, or sell bids so the bids are no longer there, and they push the price down. They push the bids down to the next level where someone wants to buy it. They push the offer higher to the next level where someone wants to sell it. And this just happens all day long, every day, in and out, in and out, in and out. And so, because of that, when you look at candles on a chart or open, high, low, close bars, if that's your jam, that shows you what humans did. Oh, on this day, during this candle period, there was a range of this. So there were some people buying all the way up to that point, but no one would buy higher than that point because there was too much volume pushing it down. Oh, it got to this bottom point, but the sellers couldn't push it below that point because there was too much buying pressure at that point. I'm getting like big picture philosophical or whatever here because it's important to deeply understand what it is you're even doing, right? It's not important to do your best. It's important to know what you're doing and then do your best. And then things like RSI, any indicators, I mean, support and resistance. What is support? It's a level that the market collectively sold all the bids down to, but there were too many bids here that they couldn't sell them all. And so the market stopped going down and eventually bounced higher because that's where there was the buying pressure. What's resistance? It's where the market bought up all the offers, but they got to that point and there was too many offers and they couldn't push it any higher. Or all the buyers bought up all the prices that they thought were good to buy. Map of human behavior. And then any indicators just help you see that picture more clearly. Moving averages, it's just a smoother thing. RSI, how much of that uh, buy pressure compared with that sell pressure are we seeing? That's it. So to squeeze out, ideally at least 5% extra on technical analysis, we need to understand that it explains human behavior. It is what has happened, the actions real people took in the market that drove prices. So it's potentially a head start. It's potentially a head start in being a better trader. Does it predict the future? Of course not. It doesn't predict the future. Show me something that can predict the future. What it does is it helps you understand what humans have been thinking about it. That's extremely valuable information. So, yeah, support and resistance, I described how that works. Now, support and resistance, there's a couple of important things here. Horizontal supports and resistance is what I described. Hey, when that stock got down to 100, it didn't go down any further. Why? Because there were too many bids there for the amount of offers there. They couldn't take out all the bids there. So that 100 moves forward because, like why? Like why were the bids there? Well, it's not that a little old lady in Iowa with white tennis shoes is saying, well, I think I'll buy it at 100 right at that moment in time. It's that there's a big institution that hired a quant who's a genius and gets paid like $700,000 a year, maybe more with the bonuses, who said, oh, this stock is worth whatever, 105. If it gets down to 100, we should buy a crap ton more. And so, does that model change over time? Well, sure, it changes over time, but does it change every day? God, no. If it changes every day, it's not a very good model. Does it change every week? No. Does it change every month? Still probably not. When you get to every quarter, okay, maybe you can make a case because there's different earnings data. But, a lot of these firms go back with 10 years of earnings. I mean, one different earnings datum might not even change their model that much either. So going forward, if that's where the support was, going forward in the future, that's where that support might be again as well. But trend line, some people will connect like lows and it'll be a diagonal trend line. That matters, but that's a little bit different than horizontal support and resistance. There's patterns like double or triple tops, flags, um, triangles, etc. Indicators, I mentioned RSI, slow stochastics, moving averages, gap measurements. These are things that are near and dear to my heart, and the candles. Okay, identifying volatility events. That's actually sort of a subset of fundamental analysis. And I've done a lot more work with fundamental analysis over the years, but if you're an options trader, an active options trader, I mean, there's your basic fundamental analysis. I mean, do you really care what the PE ratio is if you're trading a 1 week credit spread? Probably not. That doesn't much matter. In fact, there's been some studies by like LPL and some other folks that show that PE ratios do a terrible job at predicting prices 1 year from now. but they actually do a really good job predicting prices 10 years from now. So on a 1 week trade, that information is not really going to matter. But identifying volatility events, that's a big deal. When are earnings? Earnings can be the most volatile day of the quarter for a stock. Um, Fed announcements. We went through a period where Fed announcements weren't a super big deal. They came in pretty much as expected. The conference call afterwards might have moved the markets a little bit, but not too much. But things are different now. For those of you who are watching this live, we have a new Fed chair, Kevin Warsh, right? He thinks a little different than Powell. Thinks pretty similarly, but just add some nuance and there's some differences. He communicates differently, which is the biggest thing. And the market's not used to how he communicates. And he holds a little bit less stock in this is based on his own words, but it's a little less stock in the dot plots and you know, projections of the future. And so he he doesn't make as many projections of the future, which Powell really liked to do. What does the market hate more than anything? Uncertainty. There's going to be more uncertainty with him. It is my belief, which may end up being true. I think it'll be true, otherwise it wouldn't be my belief, that we're going to see more volatility during Fed announcements as a result of what I just described. Jeffrey, missed the first part. Will there be a link? Yes, there's always a link. Uh, you don't even need a link. Here's what you do, Jeff. You can go after this, and I don't know, like tomorrow, look at Firstrade's YouTube channel and just look for like my PowerPoint template, and then you'll easily be able to find this. Unemployment reports, other anticipated news releases. How much impact did each have in the past? Apple just had the WWDC. It fell a lot during that few day period. Well, it always experiences more volatility during that period. So was that probably a good time to be trading iron condors on Apple? Well, probably not, right? We learn from the past. How do we squeeze out at least an extra 5% on identifying volatility events? We just look when they are. Once we're within like 3 weeks of earnings, most companies tend to put on their website their investor relations page when they plan to announce the next quarter's earnings and when the conference call is, which is usually just following it. When is the next Fed announcement? Does anyone know? Well, if you have the Google machine, you know. Very easy. When are all the Fed announcements in this year? Oh, look, here's when they all are. Hint, 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 they're about 6 weeks apart. So, like, this is one of the easiest things you could do. I'm not going to say it earns you more money necessarily, but chances are it costs you less money on making silly mistakes. Oh, geez, why did the stock move so much the day after I put on an iron condor? Oh, because earnings happened. I wish I knew that. Oh, well, yeah, you should have known that, and you can know that. So just have resources planned out. Like on our Market Taker newsletter, we put the calendar for the week's events in it every week. You're never caught off guard if you just open that email every Sunday evening. Um, you can set alerts. What I do typically is every early January or maybe late December, I go, Mr. Google, when are all the Fed announcements during this coming year? And then, kind of old school, I don't know, maybe with AI, there's an easier way to do this now. There probably is. But what I've always done in the past is said, oh, on January 16th or whatever, there is one. So I put that on the calendar for 1 o'clock my time, Central Time. And then I go to the next one, put that on my calendar, the next one, put that on my calendar, and I set an alert, you know, the day before or something. If volatility is really underpriced, I buy some options, straddle or something. Every time you make a trade, you should always go to the investors relations page. You say, just, you know, just Google it, Google when it is. Volatility analysis. This is a crucial step in guiding strategy selection. And this is a key teaching for a market taker mentor. We're going to use a volatility chart as well as volatility information in the option chain to establish if volatility is overpriced or underpriced. Because what that does is that gives me an idea, should I be buying options or selling options? So I'm going to create my position to make the trade. Hey, should I be buying a call because volatility is cheap or buy a bull call spread to hedge it off? Either way, I still make money if the stock goes up. This is the edge. I have heard it argued that this is your ultimate profit at the end of the year. That the best case for picking direction on a stock is random. No, I don't really believe that's true. Um, but some professor types believe that's true. And in the short term, if we're talking about over a week's period or something, I think it becomes more true, which is kind of ironic, right? You would think you would be able to guess what's going to happen a week from now better than what's going to happen a year from now, but it's not really as true in the market as it intuitively should be. But this is a big deal. I believe for most option traders that I've talked to anyway, an extra 5% earned on doing a better job with volatility analysis is very reasonable and more is possible. We use our 1, 2, 3 volatility analysis. We use it on every trade, but we keep it in perspective. How do we do it? We use a 6-month volatility chart. Where do I find one? Google it. I try and share with you as much as I can, but so much of this information is out there. It's just, you have to know what to look for and how to use it. Um, 1, 2, 3 volatility analysis is today's historical above or below today's implied. Is today's implied in the top half or the bottom half of the 6-month range? Uh, what do I expect future volatility to be based on volatility events and reversion to the mean? All right, so next is stating the forecast. This is what all these analyses lead up to. This is the key step. You and I, or, Charlie and Sally could both look at the same chart, could read the same news articles, look on the same platform, and arrive at the exact same forecast. It's possible. I'm just kind of being theoretical right now, but it's possible. But they could also choose different ways to trade it, different option strategies. One could sell a put credit spread, one could buy a call. One could do a poor man's covered call, one could do a directional time spread. They're trading it a different way. One is going to make more money than the other, or lose less money than the other. This is why this is why we do all this. This is really the heart of everything I'm talking about here today. It combines all elements of analysis that we've done so far and helps us focus our intent to set up an optimal strategy. This, unfortunately, is a lot of times the most underused step by novice option traders. I look at implied volatility on every single, excuse me, on every single thing that I trade, every single time, even if I'm just buying a call. I still look at volatility because I might not want to buy a call after looking at volatility. This makes my trades better. And then my forecasting tips. Let's talk about these. A forecast isn't, yeah, I think the stock's going to go up. That, friends, is not a forecast. Over what period of time? Over the next hour or over the next 10 years? Pretty extreme, right? So, in a way, you actually already think about the time horizon. You just need to think about it consciously. Unconsciously, you think about it. If I said, what do you think about Apple stock? Well, I think it's going to go up. Okay. And then I say, do you mean over the next hour or over the next 10 years? You're going to say, I mean, I wasn't talking about the next hour. And I wasn't talking about the next 10 years. I mean, I'm talking more like a couple of months. Okay. Well, say that in the first place. And then, the move expected up, down, sideways, volatile, that's a given. But the degree of a move, oh, you think that Apple's going to go up over the next 2 months? I see. Okay. You think it'll go up like a 0.5%, or do you think it'll go up 200%? Well, I mean, 0.5% does that every day, and 200% is unlikely. I mean, geez, I mean, I'm talking about like, maybe 20% or so. Okay, say that. Put that in your forecast. Write it down on a piece of paper or put it in a Google sheet or a Google Doc. The degree of the move. What happens to volatility if that move happens? What do you mean? Well, when stocks go up, in most stocks, implied volatility goes down, although that's not true for some stocks. Most stocks, when they go down, implied volatility goes up. And again, not true for all stocks. So we need to forecast that because guess what? You have a volatility position. Every trade you make, you're trading a handful of different silos of price influences. You're trading direction, but you also have a position in time decay, but you also have a volatility position. You're going to make or lose money based on direction, time, volatility, maybe even interest rates, depending on several factors. What happens to volatility if that move happens? If a stock goes up 20% over 2 months, chances are its volatility is going to be lower than it is now. Um, and occasionally, lady's choice here, but your confidence interval. I don't always formally use this, but I know some traders who do. Hey, I expect, and this is hypothetical, this is just this example I've been riffing with here. I expect Apple over the next 60 days to go up by about 20%, and volatility to decrease by 3 points. And I have about a 70% confidence in that. Okay, now we've got something to work with. Now we can select the strategy. Because if I think volatility is going to fall and the stock's going to go up, I mean, I might want to buy a debit spread a debit call spread so that when the stock goes up to that short call strike, I'm going to be short Vega there. And when volatility goes down, I make money. You might want to do that. It also hedges off my theta risk. My stated forecast based on my analyses drives strategy selection. Mastery of this is part of the transformation from beginner to consistent success. Um, I mean, best rule of thumb is whenever you analyze a trade, find two different ways to trade it, two different option positions to trade it with, and then pick the one that's best. How do I know which one is best? Well, just think it through. I would say as long as you're doing this step, you're going to make better decisions, even if you're not always right. So let strategy just selection be a natural extension of the stated forecast. I mean, really, I would say consider among three alternatives and select the optimal one. As far as Greeks and risk analysis and exit and adjustment plans, the Greeks of strategy also guide trade entry. They also guide trade management, adjustments, exits. My max gain and loss, like using a P&L diagram, gives me my best and worst case scenarios. That is super important to risk control. I typically am never going to hit my maximum loss or my maximum gain, but it is possible. If you get a big fat tail black swan event, I could lose a lot. I could hit my maximum loss. What is that maximum loss? Well, I've got a leveraged naked put, not cash secured. Okay, so your maximum loss could be gigantic compared to what you stand to make. Does that mean you should never trade naked puts? I didn't say that. I often don't, but I know some people often do. I was just talking to a big professional trading firm this morning who was saying that's one of the things they want to get into. I mean, they're like, I don't know how much money they have under management, hundreds of millions of dollars. So, I mean, you know, we need to have a plan for our winners and our losers, whether we want to accept assignment or not, what our adjustments might be given possible market permutations, et cetera, et cetera, et cetera. And then our execution strategy. Am I going to use market order, limit order? What's my timing? Do I middle the market or not? If it's a spread, do I leg in or not? These things matter also, and it can be sometimes trickier than it appears. My best execution strategy tips are, look, everything should be made as simple as possible, but not simpler. Is there a difference between a market order and a limit order? There is. It used to be I would never trade market orders. Now I trade them more regularly because you can without trouble. Um, Sometimes I'll use a market on close order. Sometimes I'll use, well, a market on open order, which is basically just putting in a market order before the open. And then I execute my trade. I mean, that's really just tactical. That's really the teeter-totter on this or the fulcrum on this teeter-totter. By this point, we're just following the plan. But as we know, the enemy seldom agrees with your plan, and so you should have a contingency plan for what happens if this happens. Where do I get out for a profit? But where do I get out for a loss? And maybe it's not just get out, maybe it's adjust. Always know what you want to do because checklists add to your bottom line. Everything we said was is very essential to your success. You following me? All right, good. Well, friends, then I will see you next week. Thank you for putting your trust in me, and we're going to continue to do so. Have a great rest of your day and trade smart.